Hey everyone, it's Nick Weidner.
And I'm Kevin Harmon.
And we're with the Roy Real Estate Group here at Keller Williams. Today we have a very special guest with us, Mr. Marcus Foster with Leader One.
And so over the next couple of weeks, we're going to be talking about mortgages. And so Marcus is going to help us with that. And specifically today, we're going to be talking about conventional loans and FHA loans.
So Marcus, I think the first question for those viewers out there who maybe are not familiar with too many mortgage options is, what is the main difference between an FHA and a conventional loan?
Thanks, Nick. The two main differences between an FHA and conventional are that the conventional loan is held by private agencies like Fannie Mae and Freddie Mac, while the FHA loan is a government loan program. They are both extremely popular for both first-time home buyers and experienced home buyers.
And so Marcus, what would you say is a minimum credit score that people would be looking at with an FHA loan?
Kevin, on an FHA loan, we have quite a bit more flexibility in underwriting a borrower with their credit scores. We can go as low as 500 on an FHA loan with a 10% down payment. Once we get to the 580 credit score, we can look at minimal down payment options, which on an FHA loan is 3.5%.
And then, so with a conventional loan, what are you looking for with credit?
The conventional loans are a little bit more credit driven. There is a minimum credit score of a 620. And with that 620 credit score, there are options for down payment as low as 3% on a conventional loan.
So Marcus, I know one of the biggest questions that we get asked all the time is, how much money can I qualify for? So how do you go about determining that number?
Nick, that's the most popular question I'm asked as well. And there's a couple of different variables that go into that. The main variables are credit scores and monthly debt ratios. The monthly debt ratios are actually one of the bigger differences between an FHA and a conventional loan. The flexible underwriting guidelines of the FHA loan allow us to underwrite to a little bit higher debt ratio than the conventional loan. However, the biggest thing to remember when it comes to how much you can buy is that it can vary from borrower to borrower and from loan program to loan program. Everybody's situation can be a little bit different.
And so how would you define what a debt ratio really is?
Debt ratio is really your monthly gross income and your monthly debt that you pay that's on the credit report. We'll take a look at the credit report and compare your monthly obligations to your income along with the new house payment to calculate your monthly debt ratio.
Thanks everyone for tuning in again this week. Don't forget to tune in next week. We'll be talking about VA loans as well as the USDA rural development loans.
And as always, our contact information will be at the end of the video along with Marcus's. And don't forget to subscribe to our YouTube channel and like our Facebook pages. Thanks, guys.
See you next week.